Will the Reserve Bank of Australia's decision to hold the official cash rate steady bring respite to mortgage-stressed homeowners? Dive in as we unpack the impact of the rate hold on housing demand, affordability, and when rates are going to cut, as well as the fate for new home loan approvals. Let's start off with rates and when they're going to peak. The Reserve Bank has decided to hold the official cash rate this month, which is the second consecutive month on the row that they've held the cash rate steady at 4.1%. This may not actually ease any pressure for homeowners who are already struggling from the previous 12 increases we've seen. Since May of last year, the cash rate has increased by 4%, and the Reserve Bank has aimed at creating a sustainable balance between supply and demand in the economy. NAB is predicting that there'll be a single further rate increase, which will see the official cash rate peak at 4.35%. Now, this has actually been downgraded. NAB's previous forecast was that the cash rate would need to hit 4.6%, and they're actually predicting that this will happen by November of this year, following the release of Q3 CPI data. Now let's have a look at some trends. Current data points towards easing in inflation and slower demand for growth, suggesting there's a possibility that the 4.1% cash rate we currently have at the moment might be the peak of the cycle. Despite this trend, there is still some potential challenges for the Reserve Bank to face, especially concerning services side of inflation. To ensure inflation returns to its target level by mid-2024, the Reserve Bank is likely to take one additional rate hike as an insurance measure to ensure inflation gets back down to target levels. So what does this mean if you have a mortgage or you're looking to get into the market? Well, based on NAB's forecast, we might be very close to rates peaking. Now, based on historic figures, when rates peak, they're likely to stay in a peak state from anywhere from 4 to 16 months, the median being 10 months. So what that means is once rates peak, they stay there for a period of time, but after potentially 10 months, we could start to see rates coming back down. We're going to run through some more details of when rates might come down later in the video, but if you do find value in our videos, please consider hitting that subscribe button, as it really does help out the channel, and a big thank you to all our subscribers for your support. Inspires us to create more content we hope you enjoy. Looking at NAB's forecast, they foresee slower growth in the economy for the second half of 2023 into 2024, accompanied by raising unemployment. With rates peaking slightly lower than they expected, they also see that the cash rate will start to come down by August of 2024, with the cash rate getting to around 3% by early 2025. Let's dive a little bit more into the data. The Reserve Bank of Australia's recent pause on interest rates has given them time to assess the impact of inflation. Recent data reveals that inflation is starting to soften and come down, with demand coming down as well. The Reserve Bank has also been cautiously optimistic, saying that inflation won't necessarily surge if they refrain from rate rises for another month, allowing them time to really see how the data plays through. This actually differs from the US Federal Reserve's approach, which increased their rate despite inflation dropping in June. Australia's inflation also came in slightly lower than expected in June to 6%. Philip Lowe has warned that further rate increases may be necessary depending on incoming data and their assessment of risk. In the Reserve Bank's official statement, they outlined potential risks, such as persistent services inflation and the uncertainty on how firms are going to price decisions around wages and how they're going to respond to the slowing economy. Despite concerns around potential wage growth driving inflation up, the bank also notes that the aggregate wage growth aligns with inflation target if the productivity increases. We've seen unemployment remaining near 50-year lows, and it's predicted that unemployment rate will gradually rise next year to 4.5%. Michelle Bullock, who will succeed Philip Lowe as the Reserve Bank governor, is expected to bring changes in the way the bank communicates with the public. The Reserve Bank foresees financial pressure on households continuing due to the rise cost in living and interest rates, which will drop retail figures. Despite increases in financial burdens on mortgage holders, household prices in both Sydney and Melbourne have seen a slight increase in July. Now let's have a look at new home loan approvals, which have fallen to the weakest in 4 years. New home loan approvals have actually hit a 4-year low, and this is due to increased interest rates and soaring construction costs. There's been a 7.7% monthly decline in June, and this is the lowest since June of 2020. Detached household approvals dropped by 13%, and attached home approvals dropped by 10%. New home loan commitments have also dropped by 22% over the year. The impact of 22 rate increases since May last year continues to affect borrowers. ANZ sees potential signs that there will be improvements, with an upwards trend in building approval and stronger development interest for units on the horizon. Now, this month's rate pause might be unlikely to give any calm to mortgage-stressed homebuyers, and potential increased listings could also reduce property prices for more homeowners if they're forced to sell due to economic strain. We've seen increased listing numbers by 3.9% across capital cities in the June month, contrary to typically slow months according to CoreLogic. It's expected that property listings might rise faster than demand, which could potentially push prices lower. AMP's chief economist, Shane Oliver, said that a rate pause won't attract more home buyers. This is due to their borrowing powers already being reduced with the 4% rate increases over the last 12 months, meaning that their borrowing ability is 29% lower than when it was before rates started to hike. Approximately 40% of all new home loans in 2022 were fixed in, and a lot of those fixed rates are starting to come off their fixed period, with most of them to mature by the end of this year. CoreLogic's research director Tim Lawless suggests that the housing market may slow further if there's an increase in property listings with the demand not being met. And remember to like, share and subscribe to stay informed with all things property and finance. So NAB forecasts economic activity in the labour market to slow down in coming months. The RBA aims to maintain the pre-pandemic labour market gains, increasing the probability that the current cash rate of 4.1% might be the peak. NAB believes that there is likely that the Reserve Bank will take out an insurance with one more rate hike to ensure inflation is met by mid-2025, and that will see the peak cash rate hitting 4.35% later in the year. The timing of the rate hike depends on data, and NAB believe that November is when the Reserve Bank will have their last rate hike. NAB also expects that the cash rate will cut by August of 2024, which will gradually see the cash rate reduced to 3% by early 25. Guys, here at Hunter Galloway, we're a mortgage broker and help with people Australia-wide. If you're needing assistance to enter into the market, refinance, purchase your first home, we can help. Call us on 1300 088 065 or visit our website huntergalloway.com.au. Guys, as always, thanks for watching and we'll see you next time.